Thank you to the panelists. I have the iPad here, so please put in questions. Ideally easy ones, but put them in.
Please.
So we heard before from EM policymakers, and now we're going to hear from the people who listen to them and actually make investment decisions. They come from all corners of the financial system, so I'm really happy to have them here today. We don't have a lot of time, so let's jump straight into emerging markets. And I'll start with Esther. Last year was difficult for emerging markets. This year, not an easy one either. Are we talking about a collection of unrelated shocks that just happen at the same time? Or is there something more fundamental? Is something bad and it's going to be bad for a while?
Let me take your question this way. I think, if you look at the beta of the market per se, all the countries are vulnerable to global or dependent on the global growth, and that has been, being a bit of a problem in the context of trade war in particular. And secondly, all the emerging markets are also very dependent on capital flows, which I think have been touched on by one of the central banker earlier. So I think these two have been driving the direction of the bumpiness of the road. And then in terms of the idiosyncratic stories, for example, as in Argentina, let's say, that is adding to the magnitude of the bumpiness, if you see what I mean. Because in the market when, let's say there's a bit of risk aversion and liquidity reduced or crowded positioning, any negative stories can exaggerate the movements.
Mm-hmm. All right, so there's maybe a bit of both going on.
Yeah, and actually I would like to refer to one of the papers by IIF done by Elena. She did a PCA analysis on MB spread. 70% can be explained by the common factor. So I think that answers also the question about whether it's joined by one problem, a common factor, or a specific factor.
Mm-hmm. Marcus, so we saw on screen people rank debt as thing number one, and in a way, the countries that accumulate debt are countries that tend to run current account deficits for a while. So the audience seems to be hinting at an issue for countries that run deficits that they may not be able to do so forever if things have fundamentally changed. What's your view on this?
Yeah, thanks, and thanks for the invitation. Although as representing a fund or an institution that's structurally bullish on emerging markets, I would like to be on a panel that was not named EM vulnerability. Mm-hmm. But there are vulnerabilities, and dependence on foreign capital is one of the key, and it's not a new one. But then also if we look on, for instance, on current account deficits, there are a few candidates that look a little bit vulnerable. But only the EM universe as a whole, and even these vulnerable ones, are less so than 5 years ago when we had Fragile 5, even more so going back 10 years ago. So I actually think that the EM universe has matured, and these big risks are smaller. However, there are, and perhaps to bridge also the answers from the audience, there are many idiosyncratic risks. So we have a few current account deficit problems. We have a few large EM countries that have a debt problem. Some on the private side, some on the public side. And then we have yet another few that have problems with their growth model. Some are perhaps too export oriented, right? So you have idiosyncratic, and then the market tends to focus on one, right? Saying now there is a current account deficit problem. And one of the underlying structural problems is the dependence on foreign capital. I would love to see much more domestic, sticky money, pension funds, pension reforms, supporting these countries, and perhaps the ones that fall victim to the fact that some of the others are more vulnerable at the moment. So yes, it looks better, but there's still some really difficult underlying structural problems.
Mm-hmm. Thank you. So Jens, Marcus mentioned briefly growth models, export orientation. which of course is a big thing when it comes to trade tensions. They didn't come as number one on the polling question, but the number for trade tensions was certainly not 0%. They may affect supply chains. They may have already affected them. How important at the moment are trade tensions and tariffs to your overall view on EM?
Thank you, and thank you very much for having me here this morning. I think when we think about emerging markets, or at least the old way of looking at emerging markets, we thought about them being driven by three things. It was basically a high beta view on global risk sentiment. So if risk is positive, emerging market investment tended to do well. Global growth, key driver, and I would say a combination of global commodity prices and more trade. So at the moment, I think all those three tenets are challenged from the top down. So Marcus' point of the idiosyncratic drivers are incredibly important, but I also think that we are in that environment where we're all debating how sharp the slowdown is going to be. That slowdown is driven by trade tensions. Absent these trade tensions, I think we would be in a fairly stable, certainly not a bullish scenario, but in a fairly stable growth scenario. And the idiosyncratic drivers could actually come to the forefront in how we look at investing in emerging markets. And there would be more opportunities for diversification. Given the panel that we had yesterday on the supply chains, which I thought was excellent, I think there is a real risk here that we do see permanent changes in these supply chains. As I think even if you think about a scenario where Trump does not get re-elected, it's hard to see the next president to be a free trade supporter. So I think there are structural changes, and the export-oriented model is not the right model anymore for most emerging markets. And being a commodity-driven, well, in many cases, they don't have a choice. So they need to continue to go ahead with the commodity-driven model. That means that the world where Marcus was talking about domestic generated savings is going to, I think, be really the fundamental driver for growth going forward in these economies. And I continue to worry in terms of our main risk to what otherwise is a fairly constructive scenario with regards to the balance sheets of emerging markets is continued shocks. And it's not only the shocks themselves, but how uncertain they are. They can be from one day to the next. We cannot really predict it. Nobody can really give us a good sense of when is Trump going to send out his next tweet, right? And I think that's going to be the future we're in. So that means Sharpe ratios are going to be worse for a lot of emerging market investments, even though total return could still be decent.
Mm-hmm. Very good. Mila, let's talk about something else that in the last few years has been a bit of a theme in emerging markets, which is sanctions, geopolitics. It's been really important in Russia. In Turkey, it comes and goes, and now it is indeed a topic for discussion. How should we think about geopolitics and sanctions when it comes to emerging markets in the next year or so?
Yep, great. Thank you so much for having me on the panel today. As an investor in emerging markets, geopolitics is obviously one of our top considerations that we think about. And sort of to put it simplistically, in the sovereign assessment, we really look at sort of what are the economic fundamentals, which is one pillar, and the second pillar is really the geopolitics and the internal politics. And so from the economic fundamentals, we think about things like reserves, current account, surplus or deficit, inflation, and growth projections in the country. And then from the geopolitical side, we really think about what are the internal politics look like and external politics as well. So thinking around that framework, for example, in Russia, the fundamentals actually look quite strong relative to other emerging markets. It's one of the few countries with a current account surplus. Inflation has been coming down. The reserves are quite strong. And so from the fundamental standpoint, it looks quite attractive. However, on the sanctions front or the geopolitical front, we have had some elevated risk for quite some time that flared up, for example, last year with Rusal. And so the question that we need to ask then is this properly reflected in the credit spreads in the market? And then for the Turkey, the fundamentals do look weaker than in Russia. So, I mean, it's a well-known challenge for Turkey, the reliance on on the external financing for current account deficit that they have had for the last 17 years, which is better this year, but the short-term rollover of debt also requires the reliance on external financing. So from that standpoint, the fundamentals do look weaker. And then, of course, on geopolitics, we have had increased sanctions risk last year. So putting all those together, how do we think about it? It's really assessing the sovereign fundamentals and thinking about, okay, what are the degrees of freedom that this particular sovereign has to respond to any external shock, and that external shock could come in terms of lower global growth or tighter global liquidity conditions or sanctions. So, for example, then Russia has a lot of degrees of freedom. As we have seen, they have done quite fine. For example, looking at import substitution or building up reserves. Turkey is faring a little bit worse, but they still have sort of the fiscal anchor and the low debt to GDP to rely on. And thinking about it from the investment perspective, I think the market sometimes really focuses on sort of one or the other, really focusing on the economic fundamentals or really focusing on the geopolitical noise. And as an active investor, really does give us an opportunity to come in and generate alpha.
Thank you. So Lupin, in this complicated environment, G3 central banks are easing. And this traditionally is good for risk assets, but we hear more and more this discussion about is it not doing as much as before for some reason. What do you think? What do you think about this debate? And are we going to see a positive in EM from easing?
So I think that it's fair to say that policy space is lower than it was before, just given the starting conditions. But it's also important to realize that we've come from a period of crisis management and stabilization to a period where we have policy oriented towards more a regular business cycle mandate, at least a business cycle in the new normal. So I think that perhaps you don't need as many bullets as you did before. So to your question of whether easier monetary policy from the global central banks is likely to help risk assets, I certainly think that it's a necessary but not sufficient condition. You have other factors which are affecting risk. We've talked very briefly about some of them: sanctions risk, geopolitical risk, trade wars, and the like. And all of those factors are likely to have an increasing role in terms of affecting EM sentiment. But from the macro perspective, I think emerging markets are a lot less vulnerable in this cycle of easing than in prior cycles, because business cycles are a bit more synchronized than they were before. You have output gaps that are still open. Inflation is relatively contained across most emerging markets, and so easier monetary policy from the Fed, ECB, can actually aid that side. You also have EM policy constraints in terms of fiscal and monetary space also being relatively limited than they were before. So in this cycle, I worry less about the kind of wall of money coming into EM, but expect there still to be a push factor with policymakers now in a better position to be able to manage those risks than they were, say, in the previous cycle that we saw.
Mm-hmm. So let me throw in a couple of questions we've got from the audience. One is really related to that. I think it's someone who's a bit hawkish. So the question's basically, could it be that part of the easing we see is political pressure undermining institutions in the West, and that, interest rates are going down, but it's a signal of something not good at all that is coming? So in a way saying, it's not easing because the economy is weak, it's easing because institutions as we know them are not doing that great, in which case the paradigm to invest in EM changes. What do you guys think? Doesn't have to be Lupin. Yeah.
Yeah, no, yes, there are most certainly elements of political pressures on central banks in emerging and frontier markets, for sure. I remember in April, when we were here last time, there was a lot of talk about central bank independence, but in developed economies, and certainly also in this country. Not saying that they acted on the political pressure, but again, I think even though, yes, there are instances of that happening, and we can probably all think about examples. But I think, again, emerging markets as a group, as a collective, have done a lot of work, matured in this way. Just looking at where the real rates are across the EM space. When this easing cycle started, I made a comparison. I was looking and then comparing again back to 5 years ago. Where were we? And it was a tremendous scope in terms of real rate. Now there's been a lot of cuts, but again, I think that emerging markets have learned a lesson again as a whole, even though there are exceptions.
Maybe 2 cents on that. I think it matters when you see that political pressure. Clearly, the political pressure is right now occurring on the central banks in the context of global real rates going lower, right? So developed market real rates, I think, are structurally heading towards a lower, hopefully we'll find an equilibrium whether it's zero or negative in developed markets, we can probably debate, but it's heading lower. So I think that at this point, central banks, even in the context of no political pressures, would probably be much more dovishly oriented than they had been in the past. And it continues to be the case that, I mean, most of us are fixed income investors. That's an environment where we usually do rather well. Just think back to the taper tantrum. That's clearly an environment where it's far more challenging. So for investors, if the counterfactual is that we see growth slowing down and no easing from central banks, that's presumably a worse scenario. So at this point, political pressure is going in the same direction as the central banks probably would have gone by themselves too. The speed and the magnitude may be different. There are outliers. Clearly, Turkey is one of them, and the market has a tendency to quite quickly punish those kind of mistakes. And then once they eventually have to do a catch-up hike, which is a multitude of what they originally would have had to do, the market comes back and is looking for carry. So I think we are in that environment for the foreseeable future.
I think we are walking on a very tight rope right now. The balance is very fine for me between, you know, are we heading into recession and all this political pressure resulting in easing. Given the amounts of political uncertainty in the world these days, I think what I'm trying to focus on is something I can lay my hands on and have more confidence. For example, flow data, you know, negative yield. I mean, these are meaningful. And then we, as a manager, I think we focus on, okay, as long as we are in this context, we will invest responsibly and solidly, you know, as has a very strong bottom-up approach.
Okay, and the second question is someone saying the world economy slowed in 2015-16. Now it is slowing again. And back then, China put in place a lot of policy stimulus. And this time around, it's not so clear. So the question is this a big factor that is going to drive EM, or not really? China will eventually open the credit tabs, or something else will come to the rescue?
I think the China stimulus is getting more and more selective and specific. I don't think we can realistically expect, you know, we have the same style previously that China was really fueling the economic growth. However, I think the headline growth number is still important, but I just think that, like, you know, the other panelists have mentioned, it's not just one specific factor that can help to change the wave.
Yeah, we just mentioned we had several panels during the meetings talking about China and the stimulus. And while the expectation is that we will not see the stimulus that we have seen in 2016, for example, it will be more sort of surgical and precise, because they are sort of walking the tightrope of the deleveraging. You know, Xi sort of has a lot of runway in front of him, and he can't really keep kicking the can way down the road because he will still be there. And so they really have to address the debt cycle and be much more careful around the stimulus that they can do, especially with debt.
I think from my perspective, you know, the interesting question for me is, given that we know that we are having a slowing China, the additional engine of growth in terms of stimulus is a lot more diffuse than it has been in previous cycles. It's which pockets of emerging markets are a bit more shielded from those negative factors. So economies that are much more domestic demand oriented, emerging markets that have a lot more idiosyncratic risk, so you can take a view one way or another on those, and emerging markets that are less exposed to the commodity cycle. I think those are the areas where I find the most interesting opportunities, and in this kind of global environment, those are the areas that I would focus on in EM.
Mm-hmm. Yes, Marcus.
Yeah, no, I think the Chinese question is very important, but again, the more surgical is a good thing, right? I don't think China needs a massive stimulus, because that would create a lot of other problems, as it did with debt, as we talked about before. So I think that is a sensible approach to the global slowdown, and also to the rebalancing that's going on in China, as we heard in the previous panel. But then if you zoom out a little bit, look on EMs, and we can take anyone's number, but if you take IMF's recent numbers, looking into 3-4 years into the future, the growth delta between developed and emerging is widening again, and that's normally a situation when EM is doing primarily equities is doing relatively better, and again, it's not necessarily the level, but it's the growth delta between developed and emerging.
Mm-hmm. And just my 2 cents on the China issue is that if trade tensions are here to stay and the shock is permanent, it is not clear that from a rational perspective China wants cyclical stimulus, because they may well face lower growth forever, in which case you either do something more structural or you have to live with it, unfortunately. There's also a question on Turkey. We'll come back to it at the end when we do my favorite countries, Turkey and Argentina. Marcus, talking about something more positive, and you said at the beginning that your investment house is fundamentally more focused on the long-term positive stories. What are they? We definitely have very highly educated labor forces in parts of Asia, and if you look around, you do see positive elements. Can they lead to an interesting investment theme? What's your view on the optimistic side of things?
Thank you for that question. Let's start with the educated labor force. I think many of us that work with emerging markets, we've mentioned this many times, and it's true, especially in Asia, I think. But it's not an automatic win, because you need to do a lot of other things around it to get that dividend from a large educated workforce. You need to do labor reforms, you need to do anti-corruption, you need to do probably housing reform, as they need a place to live, and thinking about Hong Kong is a very timely example of that. You probably need to think about your growth model, and where are all these people gonna work, right? How can we really benefit from this factor? And that points to the larger, and I think for many EM, I can just assume for many EM policymakers, frustrating question is that reforms is not a one-off thing. It's a constant, right? You have to do, and you don't only have to do reforms, but you also have to think about sequencing. One of the reports, one of the analytical chapters coming out of the IMF this week really pointed to that. It's not enough to do reform. You need to do surrounding reforms as well, and you need to think about in which order you implement them. So I do like countries that are really trying to think about reforms, and I think China is a good example. It's a tall order, but the whole rebalancing is in the domestic economy is one of those things, and also one of the things that we probably want to have exposure to. So looking a lot on China mainland, how we can get exposure to real underlying growth. I've always liked the growth story in Central Europe. That's another positive. Political developments less so recently, but the underlying growth, even these are very export-oriented economies, and Europe is struggling, and yet growth in Poland and Hungary is keeping up. The challenge as an equity investor is to get exposure to that growth, because it's not necessarily listed companies. Africa is another good example. We see a lot of growth, not necessarily in the biggest economies, but in some of the smaller. There, the difficulty is that there are very few big financial instruments to play. But then we can look at private equity exposure. And one final comment where I am hopeful, and I think there will be is on the whole climate change and ESG. There were a few panels earlier where you can see the really big delta is in emerging and developing countries if they start changing, both for, it's needed, but also where you can see a lot of financial revaluation if that's happening. I think the jury is still out, and there are a lot of differences, but it's something that we're looking very actively at.
Mm-hmm. So let me ask a question that came in as you were speaking, and it's traditionally population growth has been seen as a good thing for a given amount of nominal debt. There's more taxpayers, it's good. The question is automation going to change this? Should we perhaps think of countries, Japan, like population doesn't grow, so there's fewer people who need jobs, and maybe they need robots. Is this something should we start thinking this way, or is it still the case that young populations that grow fast are good?
I think if we haven't already started thinking about it, we're behind the curve. I'm not saying we have this solution, but I think this is a major factor. Not only in EM, very much in developed market. We hear a lot about reshoring and who's going to produce, or the role of service economy as opposed to automation. Even in industries like ours that used to be completely isolated from automation and so on, I think is already being challenged by these things. So I think this is one of the big factors, and it may also have macroeconomic consequences how we calculate things like inflation and so on. So there this is I think this is one of the really crucial issues going forward, but also one of the more difficult ones.
Mm-hmm. Esther, a bit of the same question. When it comes to finding themes that make you positive, be it very long-term, more short-term, what kind of things are you looking at?
I think the green angle certainly is important, and it's important in two ways. First of all, we all know that China is actually one of the third largest green bond issuer country-wise, I think, globally speaking, after euro-denominated and dollar-denominated debt. And I think if we have the enforcement and the emphasis in issuing debt which is supporting green and climate change, that certainly will not just make the finance more responsible, but it's actually broaden the investor base for EM. So secondly, I think what is positive is a very, very slow process, this one, is the increasing amount of local currency debt. So now I think after the previous crisis, a lot of countries are aware of the external vulnerability. So when they can afford and when they have the right framework, for example, the right assets, Euroclear, etc., they are issuing in more local currency. And I think over a long term, this is healthy. Especially for countries which have a strong local support. For example, South Africa, a huge local pension and insurance company.
Mm-hmm. Very good. Okay, so we've spoken about some positives, but Lupin, I think the theme so far in these meetings has been more on the downside and how we think about it. So when it comes to people forming their views a bit beyond trade tensions are not good, how do you like to think about these downside risks and how you translate them into themes to watch for investors, be it regional, be it more around, the equity stories Marcus was talking. How do you structure your thinking around downside risk?
So I think that, there are a couple of things to focus on. First of all, the sources of risks you want to identify. And, at the beginning you mentioned the global risks, whether they're domestic or whether they are a source of a geopolitical risk. So it really is a consideration of what kind of risks we are focused on. And secondly, I would pair that with valuations. We haven't really spoken about emerging market valuations, but actually, to me, it's not so much whether there is a source of risk, but to what extent that is reflected in valuations. And the biggest risk I see and biggest vulnerability for the EM asset class I see is actually valuations look relatively tight to me, particularly in aspects of the high yield credit sector within emerging market sovereigns. So this really ties in also with the audience response in terms of high debt being one of the key risks in emerging markets. I don't think it's a blanket risk. Certain countries are able to have higher debt tolerance than others, but particularly in some of the smaller, higher yielding names in EM, particularly in Africa, where I do see valuations as being relatively tight, I think there are quite significant risks. And there, really, I think EM investors have to take a case-by-case approach. One factor which is a bit more concerning is the focus on a lot more local markets within those high-risk names, mainly because of the push factor from low rates elsewhere. And I think that's an area where EM investors have to be a lot more cautious than they would have otherwise.
Let me ask something very related in terms of case-by-case versus more common factors. Someone saying, look, the dollar remains strong, there's easing, but the dollar is strong, which oftentimes is not a good thing for EM. How much weight do you place on dollar strength at the moment and what it means in the next few months, quarters? I mean, not only back to the panel, if you others also have thoughts, but Lupin maybe first.
Yeah, sure. I think it is important. I think the dollar view has been critical in terms of driving EMFX returns in particular. But here again, I think a case-by-case approach also makes a lot of sense in terms of focusing on currencies which have overshot or are fundamentally cheap. I think as an asset class in and of itself, EMFX doesn't look extremely cheap to me, given where I think the dollar strength is going to go, which is more or less move sideways, but really err on the side of strengthening bias.
Jens.
Yeah, maybe another reflection on that is that if you look at what screens cheap in the EM currency space right now, it's Latin America and Latin American currencies in particular, and that's linked to your previous question, that the surprises at an idiosyncratic level this year is usually around elections or delaying elections or primaries in the case of Argentina. So to some extent, we know when they are going to occur, yet we have had surprises. And I think that there is a broader question, and it has to do with how useful are pollings and how much of a heads up can we get with regards to these risks. Clearly, that's not something that is unique to emerging markets, but each individual story has had its own problems. So if you look at the spillover effects that Argentina generated to some of the local currencies in Latin America, that's probably where you can see some opportunities going forward. While if you think about Asian currencies, looking at our valuation models, those are broadly fair value and are very much driven by the dollar view right now and the trade tensions view. So I think that we are having a bit of support for the dollar that reflects these trade tensions. And in the absence of that, you can actually make the case that the dollar is actually overshot here. And yes, we will have to see what the Fed does, but overall, different next year compared to this year. I don't think that the dollar will be the main driving force for EM market local returns. However, it does really raise a question about if you're a benchmark-based investor, how much diversification do you get from being in that local fixed income benchmark, since the dollar is such an important driver over the medium term?
Yes, Marcus.
Just very, very quickly, I think obviously the dollar story is very important. That sets the stage, not only for EM, but one thing I'm thinking of, and I haven't made up my mind yet, if we think the dollar is going to weaken, would I play that through Europe or through EM? I mean, historically, it was always first Europe and then EM. I think it may be a different order this time around.
Okay, we don't have a lot of time, so let's actually go into one of the questions that has fascinated us at the IIF for a bit more than a year now, which are Turkey and Argentina, right? They all started 2018 with wide imbalances. They were flashing red. and bad things happened in both. Last year was really difficult. Both countries have gone different ways in terms of policies, outcomes to some extent. It's a really broad topic, but Mila, what kind of lessons should we learn, or what do you think happened to these two? What are your thoughts?
Yeah, sure. So last year was an interesting one in terms of both Argentina and Turkey facing a lot of external but also internal pressures. So from the external pressures, tighter global liquidity conditions, and in case of actually both Turkey and Argentina, lower internal growth and sort of pretty sensitive points in the political cycle. And so what Turkey was able to do, they were actually able to deliver a very large current account adjustment, thus really reducing their need for external financing. I mean, to be clear, they still have an issue there, as I mentioned earlier, with the rollover of the short-term debt. But they were able to take a lot of incremental measures to really bring inflation under control, and we have seen that it actually surpassed the expectations, and on the downside, really giving the central bank the room to ease. And so and they really had the fiscal anchor in terms of a low budget deficit and low debt to GDP. So contrasting that with Argentina, they also had a lot of external financing requirements, and they were also able to adjust their current account deficit, but really sort of decreasing the imports due to lower economic growth. However, on the internal side, the administration was never really able to control the inflation, and it only got worse. And in terms of the fiscal, they were really not as conservative as they should have been. And so you put that on top of the political cycle where we had the primaries, and it was very clear that the vulnerable population that has experienced, 5 consecutive quarters of negative GDP growth and very high inflation, they were just not willing to give the administration another chance. And so really sort of analyzing the fundamentals and thinking from the vulnerability perspective, how much degrees of freedom do these sovereigns have to withstand these internal and external shocks? Sometimes they happen at the same time. We obviously see that Turkey has done a much better job comparing the two. And one thing that I'll mention, and it's been brought up by the other panelists, is really sort of the lack of the spillover in terms of the, at least on the external side, right? So maybe 5 to 7 years ago, when you see a country like what happened with Argentina in August, the market would start questioning sort of, okay, who else is with external vulnerabilities, who will be next facing the situation? And you really did not see that this time around. And again, it's to the point of the sovereigns really sort of improving their external positioning, building up reserves, floating exchange rate, comparing that to 5 to 7 years ago, really speaks to the maturation of our asset class.
Mm-hmm. So there's plenty on this topic to talk about, but that might be the last question, so let me take one more from the audience that I think links Turkey and the broader theme of growth and growth models we spoke about before. And the question is Turkey's strategy to boost credit growth periodically a sustainable one? And I guess the additional question from me is, do emerging markets rely too much on fast credit growth or not to generate GDP growth? Question to the panel, whoever is excited to talk about it.
I can start on the first part of the question. Look, I think it is sustainable to a certain extent, but not within an orthodox framework. And we're already seeing that there are limits to that. If you're looking at the loan-to-deposit ratio of the state banks, you're seeing that, left to their own devices, the private banks in and of themselves would not be extending credit, but they need a lot of moral suasion and taps on the shoulder. So I think that, yes, can it work? To a certain extent. Can it work indefinitely? Probably not, particularly given that, the financing of this is being done by leverage.
Mm-hmm.
I think given the degree of freedom, as we've talked about in the current world with a lot of uncertainty, I still believe that the countries will be rewarded way more by committing themselves to reforms and really long-term structural projects. I would say the multiplier of credit growth will probably be petering out.
Mm-hmm. Thank you all. I wish we had another 15, 20 minutes, but unfortunately we don't. So thank you for being here, and thank you to the audience for filling the room.